Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, January 30th, 2024. Welcome back to the podcast, George.
Great to be on as always, John.
Yeah, good to have you. It's been a while. There is certainly plenty to talk about. I mean, it's really amazing just how much is going on this week. You've got the Treasury refunding announcement, you have the January FOMC meeting, month-end index extension, and finally the U.S. employment report on Friday. So plenty to talk about. Why don't we go through what our listeners should be watching for these various events? And to be a little bit more specific, I'm sort of curious your expectations and how that might be different or the same from what the market has priced in.
Absolutely, and we're recording this heading into the middle of the week ahead of the critical Fed meeting, which we'll get to in a moment. But there's plenty of other things going on, as you mentioned, that are probably equally as important. I think it's important to take a step back and remember the last time we had this doubleheader of the refunding announcement with the Fed was on November 1st, which at that point really marked the lows in risk assets, the wides and like local wides and spreads, and pretty much the high yield print close to where the 10-year was at 5%. And from that moment forward, we've been in rally mode since the last, what people now call the QRA, which is the quarterly refunding announcement from the Treasury. I think, that it was really the double header of the Powell starting to get a little bit more dovish, and we're not as hawkish in November. Then, of course, we had the full pivot in December. But by and large, it was that November 1st starting point, which was the last time we had this sort of setup that led to a big rally, which then has people kind of like, thinking about like, is it repeatable? Maybe we don't get the same sort of kind of messaging out of the Treasury. However, earlier this week, we did get the quarterly estimates, which is what's necessary to finance the government. So now on Wednesday, we'll get the mix of how they're planning to do it amongst the various security options they have between T-bills, notes, bonds, tips, floating rate notes, you name it. I do think that a lot of the air has been taken out because the estimates on Monday were slightly less than expected. So that means that we should probably see lower cuts in the auction sizes for treasuries. But even having said that, I mean, the market reaction so far has been muted these last 2 days heading into Wednesday. So I think the market has a lot of this sort of less supply out the curve story already baked in the cake. Again, let's not forget, we went from 5% down to like 4% on the 10-year. A lot of that sort of supply news is probably already embedded. So there is the risk that if the cuts aren't as large or they're still going ahead with them, even though there's less financing needs, maybe the adjustment will come from T-bills instead. So I
Yeah, and
think that,
George, sorry, just to be clear, you're saying smaller increases in auction sizes, correct?
yes, correct. Yes, that's right. Hopefully that was clear. And yeah, so it's going to be 8:30 in the morning. I think it's going to set the stage for that day. And then, of course, we have the Fed. But I think the NFP is also super important with the benchmark revisions. And all of this together comes back to a thesis that we have, which I think is different than the markets. The markets, in our view, are priced to perfection. We have priced in the Goldilocks, the soft landing. We've priced in a lot of cuts, even though some cuts are coming out. But we have basically priced in this idea that we're going to get this sort of outcome, and any sort of deviation from that path should reflect in either wider credit spreads, lower stock market risk markets, and and potentially even higher rates too. So I think it's going to come down to expectations, which I think are now pricing to perfection.
Yeah, well said. And I think we kind of touched on this briefly, but a ton of going on this week. Arguably the most important is the FOMC, particularly as they seem to be at a bit of an inflection point. Between they were hiking rates, they are now on hold, and it certainly seems like they're going to move towards cutting rates for a variety of different reasons. But I guess I'd like to pick your brain on the Fed specifically in a bit more detail. I guess let's talk a little bit about this week for sure. I'm curious how developments this week might influence the FOMC, today, but also your more medium-term view on the Fed. As example, if I recall correctly, you've been calling for a 25 basis point cut in March since July. So I think the readers might, or the listeners rather, might find it interesting what you saw then and how it compares to what you see now.
Yeah, no, let's do play by play, and this really comes down to sequence. How do we get to the next step of each Fed move? We think that this week they're not cutting. They're on hold again. Um, the the focus should be on, is there a balance of risk now that is more even between growth and inflation? So we'll see what the statement brings us. Chair Powell in December did pivot in a pretty dramatic way, opening the door to at least entertaining the idea of easing. And so I think that we should expect a lot of kind of questions at this press conference, relating to timing. I don't think that we will get a certain answer on like when the next move is, but they would have to at least go to neutral on their statement, and then stay data dependent, and that keeps March in play. It doesn't push it back. Now, if they're in order to kind of keep going with this kind of sequence concept, the prior week we had the Fed alter the terms for the bank term funding program, which for us we've been focused on that as well. So if you think about the sequence, pivoting in December, adjusting the BTFP before this meeting actually takes place, at this meeting, and also in between them, we also had the minutes which suggested they're looking at the balance sheet. There's been a number of Fed speakers also mentioning that the balance sheet tapering process should be adjusted. So it's possible that we don't get any rate changes this meeting, but the actual, as we call it, the countdown to QT taper, I think is now here. So we either get further discussions that they prepare the public for eventually tapering will happen in the QT space, or they actually announce it. It's a real distinct possibility they can announce it as soon as Wednesday. And that would be like in lieu of a cut. And then the question is, do they cut in March, May, or June? I think that's going to come down to the data, purely the jobs data, because inflation is moving in the right direction. And by March, we would expect them to acknowledge that. And again, they might even acknowledge it tomorrow that their own estimates of inflation are now too high versus where inflation is annualizing. So there's a lot to chew on. I think that this is going to be a dovish outcome, even though we've heard a lot of Fed speakers push back on market pricing in cuts. I think that was just trying to buy optionality and to really slow down the markets a little bit. So we'll see. I mean, Powell typically sounds more dovish towards the end of the press conference. We're wrong if he really goes out of his way and is overtly hawkish and actually tries to push back on the markets. I just don't see that happening. They're already restrictive on real rate terms. They've mentioned that before. I would expect Powell to say something similar. And at this point, just from the macro reasons, they should start easing, or at least normalizing process. Normalizing rates is what they'll probably call it. They're not really easing. They're still tight relative to neutral. They would have to get rates down into the three handles to start to suggest that they're actually easing. So I think normalizing policy is a smart thing to do. It's been in our forecast. To answer why we've had it in our forecast, we've had it for a variety of reasons. One, you're never on hold forever. And the natural next move, which has been the case throughout every cycle that we've had rates, has been that they usually ease afterwards, because either they hike too much or the economy does react to the tighter financial conditions in the banking system, at least, and in terms of the cost of money. So, the interest rates do matter, and then eventually they have to dial them back a little bit. So after a hiking cycle, at some point there's an easing cycle. So this is nothing really mysterious. We thought that at some point they're going to have to go the other way, and it also so happens to be the anniversary of the banking crisis that we had last year, and they've are making changes there. So I think steepening the curve sooner helps the banking system. But it's really comes down to March, May, or June. Beyond that, if they haven't eased, then it's because the economy is very, very strong or something else has changed. So we're relatively confident. There's no need to change unless the economy accelerates from here. the banking system gets even more healthy and starts to lend further, liquidity issues fade, and we get better outlook on the global economy. Too soon for all that to happen in the next 2 months, in our view, and so the Fed doing an insurance ease in March, I think, is the right direction, right step.
Yeah, that makes a lot of sense to me. There's also an article in the Wall Street Journal, that kind of made that higher real rate, argument. As you said, a cut here is really normalizing policy, given the fact that inflation's coming down so sharply. Um, and that makes a lot of sense. So we'll see what happens. This podcast, as a reminder for our listeners, this podcast will drop on Wednesday, January 31st, which is the morning before the FOMC meeting. So we'll know more in just a few hours. And for our listeners, I would encourage you to check out George's recently published January FOMC preview, the countdown to QT taper and rate cuts. And if you are still not receiving George's strategy reports, there is a new way to get them. Check out the new MUFG research portal at www.mufgresearch.com. You can get all of our research there, as well as sign up to receive your favorite MUFG research delivered directly to your inbox. Great stuff as always. Thanks, George.
Thanks, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.